the session, and then we can see how much time we can cover here. Okay, all right. So I'll just we'll continue with the classes from the with the topics from the previous session, which is we ended at the discussion of implied volatility. Now you'll find in this course I will try to refer more to the book than I did in the previous course. Because here a lot of material is technical, and you can actually find corresponding material in the book. But I will still have to use some of my own notes, because otherwise you will not, because the books are not written by option traders, so they don't have the trader's perspective. So they're not really thinking about what kind of problems you will face when you actually have to trade. So there are certain things you will not understand if you just read the book. So for those, I'll use my notes. Okay, so we've already covered all that, and therefore, so this particular module that we are doing now is quite important from that point of view, which is the I-Vol part of it. Okay, so this is where we stopped. All right, the view is a little bit. This is where we stopped in the previous, in the previous class. So we said we are discussing this important, and I will also stop repeating a little bit to save more time, because everything is recorded and the videos are available. So I will not repeat. Usually what I used to do is repeat the last previous session's ending part a little bit at the beginning of this, which many instructors do actually. It's a normal way of teaching. But I will try to reduce it so that we can actually save more time. All right, so you can always refer to the video of the last part. Okay, so of the last class. So I-Vol is what we were discussing, and we said essentially that, again, this is my peculiar way of dealing with this topic, which is based on my experience trading options. So you will not find this kind of focus or discussion when you read a textbook on options, because those guys are not really talking from a trading perspective. It's more theoretical. It's more from an academic kind of perspective. But if you will, if you read the books I've given you in the finance reference, you'll notice that there are connections to this. There's a book called Option Volatility and Pricing Strategies by Sheldon Nattenberg. That book is very good.
Partially filled.
Okay, sorry, I need
filled.
Okay, they're actually telling us all the orders that are being filled by all you. So somebody is selling ExxonMobil. They should not be doing that. I need to just let me just move this away for the moment. All right. So actually, they should not be trading in there. Of course, now you're practicing. But even in your practice, you should be trading in the options, not in the underlying. So here, because mine is a master account, so
partially filled.
1 minute. Let me just stop this thing.
Partially filled. Filled.
1 minute. I have to mute this. I have to mute this thing, because otherwise it'll keep disturbing us. This sound. Okay. We get to see what people are doing. If I hope this will record the audio. That's the problem. Okay, I don't know how to. 1 minute. I need to find a way to disable this. I'm trying to look for the control. 1 minute. I need to, because
partially filled. Filled.
Okay. All right. We'll just ignore that. We'll just ignore that for the moment, and we'll just go through that. We'll just ignore that. We'll go through this. I'll have to close this maybe, because they keep giving us these. And where is that control which we had, which I can't find now? Where to stop this thing? Okay. All right. So we'll just try to ignore that that noise when it comes in. That
partially filled.
It's becoming very irritating.
Filled.
1 minute. 1 minute. Let me just find where this tool. I can't find it where it used to be. So. Okay, never mind. We'll see what we can do here. All right. So we'll just try to see if we can manage through that continuous update system. All right, so the first answer is, the first question is, so this way of looking at I-Vol, which we already covered here in the first place. Let me try and explain this, why I opened the TWS today. I'm also testing the system RAM. All right, look at this. The first answer which I've given you is, when you try to understand what I-Vol is, the first answer is that this is an indicator of how cheap or dear the option is. Let me show you what I mean by that. Okay, let me just bring back the view of the TWS and take a chance of, yeah, let me bring back the view of the TWS. So what you can do is take any of the tickers that you have. All right, let's say we take Apple. All right, and what you do is you take Apple and you do a right click on Apple if you want to see the option trader. This is the tool that will be very important for you in this particular project. So you right click on Apple or you left click on Apple and you see, so essentially you right click on any of the bid or offer quotes and you have to right click. Then you go to trading tools. Okay, now because I've used the option trader before, this is also like a frequently used module, so it's already there for you. But if you haven't used it, that's the first time you're using it, you'll have to go through this. So go through trading tools and you go through book trader. Book trader shows you the depth of the book, and here you got the option trader. So if you open this, if you click this, you will see this kind of display. Now what I'm trying to show you here is typically when you trade options, what kind of trading display you have. I'm going to close this. Here you see some of the discussions of the put call volume, which Siddharth had discussed about. He had asked about several classes, some classes ago, this put call ratio, which people look at. So you can see all that. Let's try to close all this so that I get to show you just the option chains. Okay. I want to see the quote panel. So this is what you would be looking at when you're doing your trading, on your option trading. All right. So this is, remember that, so these are options on Apple. So on the top, you see the display for Apple shares, underlying shares of Apple. Okay, so 114.30, 31. We can see where it is in terms of, let's look at the chart of Apple. Instead of looking at Oracle, we look at Apple. Right. All right, so here you see this is where Apple is. So 120, 115 or something like that. Yeah, 115, something like 115. So this is where you understand, once again, the relationship between derivative instruments and underlying instruments. So what you're looking at here, this is the underlying instrument, which is the spot instrument on spot trading in common stock of Apple. Okay, so the instrument is spot and the market is common stock of Apple. This is your underlying asset and this is your derivative product. You have prices for calls and puts. The prices are being shown here, bid and ask. Okay, so this is under puts, you have bid and ask for puts, and under calls, you have bid and ask for calls. All right, so this is where you are looking at, these are the derivative, this is the derivative market, these are the prices, and these are the prices for puts, these are the prices for calls, the derivative market here, and this is the underlying market. Okay, so you see both of them in one view, because this is typically how people trade. So remember, in this project, what we are doing is we are putting a particular constraint on you because we want to teach you to trade in a particular way. So, we are teaching you to trade in a purest way without trading in the underlying, just trading in options. Okay. Just like when you go to, when you're learning how to play like bat in cricket, they initially teach you to bat inside the V. So you don't try to hit any angular shots. You try to bat inside the V, so that we are trying to teach you how to trade in a pure manner, just trading options, and then later on you can mix it up when you learn to trade like a market maker. So that's the idea here. So we just look at, so you're not trading in the underlying, but you will look at it as a reference because you'll have to form a view on the underlying. All right. So here we have calls and puts. Now, what do I mean by the point we are trying to illustrate here is this actually. The point we are trying to illustrate here is this. Let me just go back to the notes. Here, what we're trying to show you here, just to illustrate the point that we covered the previous time, that this is an indicator of how cheap or expensive the option is. And this is how you understand it, okay? Which is, that's why I wanted to open this. So from here, right clicking, I have opened the option trader for Apple. And this is how you, one of the ways in which you can do it. You can figure out other ways to do it, where you look at, take a view on any particular underlying, you take any of each of your underlyings by turn. You have all your underlyings here, over here. These are your underlying tickers. So Apple is one of them, and you, whatever I'm doing in Apple, you do the same for every one of them, one by one. Okay, by turn, you take them by turn and you do them one by one. You do the same kind of analytical routine. All right. So what you do here is you launch Apple. You launch the option trader for Apple. Now notice here when we discussed, you remember when we discussed the decision problems. Now, when you're talking about decision problems, you have one of the decision problems you have in option trading, which is not there in spot trading, is that you have to now think about the tenor of the options as well. If you remember in our option decision problems, we have tenor as well as one of the, I'm not going to go back to the notes there, but you know that we had tenor as one of the decision problems, and you can see that problem here, okay? So here you got, the system is asking you which options do you want to look at? Do you want to look at the options which are expiring 3 days, the ones which are expiring in 10 days, or the ones which are expiring in 17 days, all right? So in this case, I want to maybe look at something else. Let's look at this. If I want to go a little bit longer than that, if I want to go here, now what we know is that this particular US election, there's a little bit of uncertainty still, okay? So there are a lot of these legal challenges. And so therefore, but I think what will happen is by December 14th, there's a constitutional requirement. They will have to certify who has won by December 14th. The electoral college votes will have to be tallied. So let's look at the December 18 expiry. That's an interesting expiry, but because by this time we will know who the actual president, the new president is in the US, okay? So that's why I'm looking at this maturity, and I'm not interested in the short dated ones, okay? I'm just telling you, you can do whatever you want, but this is how you look for maturity. So this is one of the decision problems I just solved. When the system is asking me which maturity do you want to look at, because you can only look at one at a time because the human brain can't focus on everything together. So I have to choose a maturity. So I chose this, and you can understand my logic for choosing that. All right. Now, once I choose that, you notice one more thing. Apple is around, say, 115. All right. So here you see the strikes are put in this way. Now, this is called a straddle view, where the strikes are down the middle, the display of prices, the straddle view for display of prices. If you go to the Yahoo Finance display, you'll see the same kind of logic terminology that is used. So in fact, when you have to pick up on all this lingo. So if people ask you that when you're doing your option trader, do you usually have a straddle view? This is what they mean. That when you look at the option prices, you put them like this. You put the strikes in the middle, you put the calls on this side and the puts on this side. Of course, you can have puts on the left, calls on the right, but they're on either side of the strike. And so this is how you read the prices, all right? This is called a straddle view. Straddle as in how you straddle a horse. You'll see it written there on the Yahoo Finance website. Okay, now what did I mean by calls? And I-Vol is an indicator of option prices. Now, this is one of the important reasons why we are using this software. Very few software will give you this kind of display. Yahoo Finance will not give you this kind of display. Now, notice something. I'm going to go for the at the money, let's say look at the at the money calls, all right, nearby. So these are actually not at the money, these are just out of the money. Now look at this. Now, can you see this when I mouse over this 495? You see two numbers, there's 495 of course, and then there's a 35.37%. Can you see that?
Yes, sir.
Okay, all right. Now this is why this software is special, that it is giving you live quotes and it is telling you this 35.37. Now 35.37 is the I-Vol that is implied by this price, okay? So when the offer price, so this is the bid price and this is the offer price. Let's just look at the 115 Apple call for December 18th. So when you have to refer to these instruments, you have to clarify lots of things. You have to clarify whether it's a call, you have to clarify the strike, you have to clarify the tenor, okay? So that's why I said, let's look at this call. Let's look at the 115 Apple call. You have to also clarify the underlying, of course. I said, let's look at the 115 Apple call for December 18th expiry, okay? And let's look at, within that, let's look at the offer price. And I look at the offer price, it says 5 and in brackets is 35.32. Now that means that this 5 of, what does that actually mean? That this 5 is associated with, it implies an implied vol, I-Vol of this 35.32. Then you can read this also. It's 34.99. Okay. Now you notice the bid is the I-Vol. Can you see one thing? 495 is less than 505 or 5, and 34.99 is less than 35.32. Okay, this will always be true. So that's why I said that I-Vol is an indicator of option prices. So now the first lesson is that this may be there somewhere later in your notes as well, but I'm going to write it down here also, that I-Vol is an indicator of option cheapness and dearness of options. So when we are coming to this, we can write one more letter here. Higher I-Vol implies more expensive options. Higher thing implies more expensive options. And then of course, we can write it for the lower I-Vol. Lower I-Vol implies higher, lower, more, and less. Okay, this is important. Okay, so this is what we mean by that. That it is higher I-Vol implies so this, I mean, what we are trying to learn here is that when you're trying, suppose you're having a discussion between us, your team, let's say within your team, you have a team trading options, and your team has decided to buy the Apple 115 call. Okay, let's say your team has decided to buy Apple calls for December 18th expiry. Okay, but they're not sure as to which strike price they should go for. They're trying to decide the strike price, because this will also become a decision problem. Okay, because if you decide to buy calls for Apple and you've chosen the expiration, you still have one more decision problem, is that you have to choose the strike price. Because for December 18th, under Apple, for calls, you can have so many different strikes. And these are just a few, actually. They're showing just a few. You can see even more. Now, the question is, which one should you buy? Now, normally people would say, okay, obviously when you want to buy stuff, want to buy cheap stuff. And when you want to sell stuff, you want to sell higher, more expensive stuff. Okay. So then obviously you would try one way of thinking about it is that you buy the cheapest option. Okay. So here this would seem that this 2.2 approximately is the cheapest. All right. But the point is that this is not how you decide whether an option is cheap or dear. The way you decide is by looking at those percentage numbers. Here you see it's 33. Here you see it's 34, it's 34.5, this is 34.2, 34.5. I'm just looking at the, let's say, since I'm buying, let's look at the offer price, because this is the market maker. The market maker is quoting bid and offer prices. So if I'm a price taker, the market maker is a price maker. If I'm a price taker, I have to trade on his offer. If I have to buy, I have to buy on his offer. If I have to sell, I have to sell on his bid. All right. So if I'm interested to buy and I'm looking for the cheapest option, I don't look at this 2.34 part. I look at the 33.95%. This is 33.95, 34.55, 34.88, 35.29. This is 33. Okay. 35.29, 35, 36, 37, and 38. Okay. So these are actually fine. In this case, it happens that the lowest I-Vol is your 33.95, but this may not always be the case. Okay, it depends on how the curve looks in that market. This is a function of market prices and market activity. So this is how you would choose the cheapness or dearness of the option, which is the cheapest option, not based on what these absolute numbers are showing you, but based on when you mouse over. So real good option trading software will always give you this. Along with the actual prices, 227, 229, it will show you the I-Vol associated with that price. Okay, that's what it means. So this is the first thing. What it means is this, that it's an indicator of cheapness or dearness. So you look at the I-Vol associated with the price, and accordingly you determine which is cheaper. 33.6 is cheaper than 33.997. So this option is actually cheaper than this, which is on the face of it also, on the absolute price also, but you never really look at the absolute price to take that decision. That's the first lesson. Okay. And what is that? Okay. And so this is the first understanding of I-Vol, and this we already had a discussion that the I-Vol is, the price of the option is affected by the intrinsic value and the time value. All right. And the time value, this already, we had the discussion in the previous class. So you can refer to the previous class video as to what is affecting the the intrinsic value of options and what is affecting the time value of options. Okay. Now, the part we didn't cover in the previous class is that since the price impact on option comes from this, you will discover as you trade. Since the price impact on option comes from the intrinsic value and also time value, both are contributing. Okay, it's very simple to understand. So both are contributing, and so if you imagine there's a team where you have different team members, and they can sometimes have positive scores and negative scores, and the total team score consists of the scores of all the team members. Okay, the individual scores of all the team members. So now what might happen, so therefore the total, so it might happen, what might happen in one particular session is that some team members have some team members have a high positive score. Sorry. Wait, there's a yeah, okay, all right. So some team members, so what we were talking about is that we are trying to understand this point that the price of the option is affected by both IV and TV. Now, just this is less like a team score is being affected by the the individual scores of all the members, and some can have positive scores and some can have negative scores. So every innings you go out and play. Now, some team members may have positive scores, but some team members may have negative scores. So the negative scores might actually outweigh and may be more in absolute value terms than the positive scores. So even though some guys have scored positive, the total team score actually goes down, because there's some bunch of people who scored a lot of negative, lot of negatives. They had a lot of negative scores, so they pulled down the total team score. It's the same kind of concept. Okay. So what we are trying to understand this, we are expanding on the discussion that we had in the previous session, and it's very useful to think of option prices as consisting of these two. And what we are saying here is that the impact is different for the two factors. Okay. So what might happen is that the impact of one factor can more than offset the impact of the other factor, which is what I explained. I'll explain what I mean by this. Okay. So you can see this. All right. So I referred to the books as well. So in this course, I will try to refer more often to the book whenever possible. Okay, this may not match, the pages may not match, so you can ignore that. But you go with this, the figures will match. You go to figure 1.1, 11.1, 11.2, you will understand what is being meant. Okay, so I'll explain briefly what is meant. That you might have, let's say, let's explain it with respect to this. Okay. Now you see, in this case, in the case of this option, the underlying is here, the exercise is 100. All right. So what happens is, look at the call option price is 3.02. Okay. Now let's say the underlying, after you buy this underlying option price, the price goes up to say 110. All right. So you see the price of the option has gone from 3 to 10, 11. Okay. Now this has happened. You can see straight away that here, this has straight away gone, because the exercise price is 100 and the underlying price is 110. Okay. So we'll try, so here if we ask, we'll try to also have, because I believe some of you are falling asleep and not finding the class interesting. Now, as I said, if I keep asking questions, that will slow us down in terms of coverage. It will slow us down in terms of coverage, but it will hopefully make it more interesting for you guys, because some of you are falling asleep and not finding it interesting. But as I said, you should already find finance interesting. So let's see if I can find some students to ask questions to. Where is the, okay, let me just try and see if I can find some students who I can ask questions to. All right. Okay, let's ask, Okay, let's ask Abha. Abha, what is the intrinsic value of this option now? This call option with the exercise price of 100 and the underlying is at 110. What is the intrinsic value of this option? Can you tell us? If your mic is not working, you can answer me on the chat. Yes, Abha has gone to sleep. Okay. So let's make a note. So some of you are actually, okay, so Abha has answered on the chat. Okay. The intrinsic value, okay, Abha is saying it's 110. Okay. Anybody, let's ask somebody else. 1 minute. Let's ask, who else can we ask? Let's ask Gagan. Gagan, what is the intrinsic value of this particular call that you're looking at? I'm talking about the call option, the exercise. You can see everything here. Just tell me what is the intrinsic value. Abha says it's 110, right? If I understand correctly. Abha's answer is 110. Okay, so she's already, yeah, you can all see it. Okay, so Abha says 110. What is Gagan saying? Gagan is sleeping. Okay, all right. So, okay, good. Let's try somebody else. Let's try Gaurav.
Sir, I think it's 10.
Okay, Gaurav thinks it's 10. Okay, all right. So I'll just tell you what I'm doing here. Okay, as I asked the question, so I think some of you are under the impression that CP is not being marked. But actually what I did was, because now of the pandemic and all that, I'm just trying to be a little bit lenient. So normally how I've been grading the CP is those who are very active and participating. I give them 100% score on CP for the 20% of the grade. Okay. And then I have 3 classes of students. Okay. And so I have those who are very good. I used to have 4, now I have only 3. And then I have those who are very good and those who are average and those who are poor. Okay. So those who are poor, I've given them in the previous IPM, I wanted to be very lenient. So I gave them 40%. But this time what I'll do is I'll give them much lower scores. Okay. I'll give them maybe 50, I'll decide later, but much lower than 40%. So those who are not getting anything, in fact, I used to give them 0 earlier. So so let me just put in Gaurav's score. So I'll randomly take some scores. I'll come to Srishti, 1 minute. Okay, 1 sec. Yeah, Srishti has raised her hand. Yes, Srishti?
Sir, intrinsic value would be 10 here.
Okay, so Srishti is saying intrinsic value is 10. There are other people also have raised their hand. 1 minute. Let me just put in Srishti's marks. Okay. Okay, 1 minute. Srishti is fine. Okay, let me just take 1 second. Just hold on. Just give me a second. Just give me a second. So I have marked Srishti and I've marked Srishti. Just hold on. Just 5 participants have raised their hand. Very good. It's good to have activity. Then you guys wake up. 1 second. Just hold on. Nikita. Okay, let me wipe out Nikita's also because I think from the previous, I'm just looking at the. I have marked Abha. I have marked Gagan. Okay. All right, now let's go to the 5 people who have raised their hands. Actually, I can't seem to see them.
Excuse me, sir.
I got it. Okay, let's go one by one. I think Srishti we have already covered. Next is, I'll just go from the top, not in the order they raised. Okay, start with Utsav.
Sir,
it is -10.
Okay, Utsav is saying -10. Just hold on. I'll do one by one. Okay. Utsav, let's have a little CP session. Okay, so let's have a session. So Utsav is over. Then Vitali. Okay, what is your answer?
Sir, -10.
1 minute. Vitali is also -10. Okay. Then next is Sachin. Yeah, what is your answer?
Sir, -10, 100 minus 110, -10.
So the intrinsic value of the 100 call is 10.
Minus 10. If his call option minus 10.
Okay, 1 minute. Let me ask. Let me put Sachin's mark. Okay. All right. Okay. Next is Harsh. Yes, Harsh. Harsh is answering in chat.
I think it is 10.
Sorry, Harsh, come again.
I think it is plus 10.
It is plus 10. Okay. Harsh.
Plus 10.
Sorry. Yeah, I couldn't hear you. What is it?
Yes, sir.
Sir,
plus
he is
10.
saying plus 10.
Yeah, plus 10. Yeah. Okay. Got it. Let me find. Why Harsh? Not Harsh's name should be after G Gaurav. Okay. Maybe Harsh is towards. Okay, Harsh is towards the end because he joined. Okay. So Harsh is saying it's plus 10. Okay. All right. Okay. Next is okay. The whole class has put up and good to see that there is activity. Okay, Rishabh next. Rag. Yes.
So minus 10, sir.
Minus 10. Okay. I hope you're not talking about your CP score. Okay, 1 minute. All right. Okay, 1 minute. Rag is minus 10. Okay. All right. Then next is Bhavya. Yes, Bhavya.
Sir, minus 10.
Yeah, actually, so Raghav.
So 10.
Raghav is saying 10. Okay, let me get to Raghav. Okay. So actually now you see why Raghav, you're answering for the first time now, right? Today you're answering for the first time, correct?
I think so, for the second time.
So what did you answer first? Either first question I'm asking, right?
I don't remember exactly, so but I contributed as well in earlier classes.
No, not earlier classes. I'm talking about today. Today you're
Yes,
contributing
sir. Today, yes, sir.
first time, no? 1 minute. So
Yes, sir.
10. Okay, 1 minute. Raghav is saying it's 10. Okay. Next is Mukul. Mukul, what is your answer?
Sir, it will be 10.
Mukul is 10. Okay. Then Shaurya. What is your answer? Are you answering through chat?
Yes, sir. It's minus 10, sir.
Shaurya is minus 10. Okay, 1 minute. Okay, Shaurya is minus 10. Okay. All right. Any more hands? Aman?
Sir, minus 10. Minus 10, sir.
Okay, 1 minute. So Aman is minus 10. Okay, good. Then Priya is also. Everybody's hands is going up. The hands keep coming up. Piyush. Okay, let's go to Priya first.
Yes, sir. According to me, minus 10.
Minus 10. Okay, fine. Everybody's hands are going up. Okay. As I say, when these hands come up, everybody wants to join the Congress. Okay, what is this? Next is Piyush. Okay.
Yes, sir, it is minus 10.
Minus 10. Piyush is also minus 10. Okay. Now use. Okay. Any more? No more hands. Okay.
Sir, you took my name, Nikita here. So,
Did you actually answer today? No, Nikita actually was because I from the previous course. Nikita, you
sorry,
did
sir.
right?
I didn't answer, but you took my name.
No. Your name because I copied this from I copied it over from the scoring sheet from the IPM course. So
Okay, sir.
I had put in a score for you. So that's what I was seeing. I was seeing where those. I was looking at all the names where there were scores, and I was trying to make sure whether they had answered today or not. Okay. So, so these guys let us, so you guys like this kind of session in between, having a quiz session, little wakes everybody up.
Yes, sir.
Yes, sir.
Yes, sir. Yes, sir.
But for only 5 minutes, sir, in between.
Only for 5 minutes, right? Yeah, but not more than that. Maybe one question per day or something. So actually, just explain because I've got a lot of feedback. People are saying they're a little bit bored or something like that. So let me explain to you so you understand what I'm doing also, right? So that you understand, like if I'm doing something, you understand why I'm doing it. Okay. Now the thing in this course is that there's a lot of material to study. Okay, it's very technical. Option trading is a very technical field. And since you're going to be finance students, I have to give you proper technical training. All right. So now, as you can see from this little example that we conducted this little quiz session, now you see that we we woke everybody's excited and they are woken up and all that. But you see that we have actually not really covered much in terms of new material. Okay, I'm just actually examining you on the previous material. Okay, so I guess we need to do this also. So the reason that you find me doing mostly lecture style, and then of course whenever you have questions, I try to answer the questions. Okay, you'll see that I answer questions I'm very particular about answering questions. Whenever anybody asks, I never put any question down. I always try to answer all the questions to satisfaction, because that's what I want to do. So I will give you a lecture, and then, okay, I say this is how you bake a cake. And then whoever doesn't understand how to bake the cake, then they'll ask a question. Okay, how do you crack the egg? Okay, this is how you do it. Okay, and this is, so that's what I want to do. Now, that way, what we can do is we can cover a lot of material, okay, in the lecture style, you see, because I'm not spending any time asking people questions and taking their scores down. So there is a trade-off involved in this, and that's why I said in the beginning of the class, you understand. If you remember at the beginning of the course itself, I said that it's not my job to make finance interesting to you, because as finance students, you should already be interested in finance. So my job is to actually design the curriculum, to decide what has to be taught, okay, and that includes the choice of how much from textbook and how much from my own material, because you know, I have trading experience, so I know what you really need to know. And that's one. And then second, of course, delivering the material, like teaching you how to think about I-Vol, what is I-Vol, all the stuff that we have discussed today. And then explaining, when I teach something, okay, people may not understand exactly what I said, okay. So then explaining, that is the most important part of the class, where students ask questions. Okay, I just taught you how to crack an egg, but somebody didn't understand. So they ask a question, okay, how did you crack that egg? Then I explain how it's to be done, okay? So this is what I do. So this is why I'm doing it this way, because my goal is to cover maximum material. And I feel that every time I have a quiz session, I will waste some time. That's why you see one of your buddies, I think Utsav or somebody said, not more than 5 minutes. So, okay, so this is—
Sir, it was Harsh.
Okay,
it was Harsh.
Harsh, okay. So this is so I understand the situation may not be optimal. There will always be some people who are not happy with the style or anything, but at least you understand why the teacher is doing what he's doing, you know. So I'm giving you a look into my psychology also, why I'm doing the thing I'm doing, whatever I'm doing. Okay, so we'll do it that way, but we try to put in a short quiz every time to make everybody happy, so wake people up. Okay, now, so the answer, let's look at the answer. The answer is basically, the correct answer is what Gaurav and many others gave, okay, is that Mukul, Gaurav, Raghav, and that is that the answer is the intrinsic value is 10. Okay, remember what is the how do you remember? If you remember now, I will not ask a student to give the explanation, but okay, let's ask somebody. Let's ask Mukul. Now remember, what is your Mukul? What is your reasoning for saying that the intrinsic value is 10?
Yeah. So because to calculate the intrinsic value, the formula is the current price minus the strike price. So underlying price is 110, the strike price is 100. That's why it's 10.
Okay. So then if I use your same formula, for that formula is only for calls or all for calls and puts?
Sir, this formula is only for call.
So then your answer, you have to, in your answer, you should clarify that. No, you're giving a very particular answer. You have to answer in terms of general terms. Okay. So
yes,
whatever you discuss, so actually the answer you should have given is that this you have given the mechanical answer. If you go back to your part of the notes on the intrinsic value, I'm not going to do that, but I'm going to go there. Maybe you can go back on intrinsic value where you have that little diagram from this. So what Mukul has given is this answer. Okay. But this is just the mechanical calculation. This is what you should think of. Okay. Actually, the way you should have given the answer is this. This is how you come out with the calculation of intrinsic value. This is what you should actually understand in terms of concept. Instead of remembering the formula, you have to understand, okay, what is the call option? So this is this logic that I'm giving you. I'm just going to show it to you here. Okay. The way you understand, if somebody asks you what is the intrinsic value of the 100 call, So what will you do? Intrinsic value is always found by, okay, 100 call. That means if I buy the 100 call, exercise the 100 call, okay, so if I exercise the 100 call, that means I buy the underlying asset at 100. So if I buy the underlying asset at 100, and the next part of the discussion is, then I square. I'm not showing you the notes, but I'm just telling you, you can refer to it. So what you have to do is ask yourself, this is how you understand the fundamental concept of intrinsic value. Instead of remembering the formula that, underlying minus strike price for calls and strike price minus underlying for puts, that's kind of mechanical. You have to understand intrinsic value means I have to ask myself, how much money can I make in terms of positive profit by exercising the option and then immediately squaring the position in the underlying market. So I exercise the option, I buy the underlying asset for $100, and the underlying market price, the market price for the underlying asset is 110. So I will buy at 100 and I will sell it off at 110. I'm squaring off my position, and that's why the IV is 10. Okay, so this is how you should understand IV. All right, so we have a little, so now we have what is called a lecture tutorial session. So I gave you a lecture on IV earlier. Today we had a little quiz, and then we found some people gave right answers, some people gave wrong answers, and one of your dear friends was found to be sleeping. That was Gagan. Okay, so so now what we'll do is I will if you have a problem with your audio, you have to answer me in chat. So one of the two I have to take, so to make sure that people are awake in the class. Okay, so so the answer, so but at the same time I have answered, now I have given you the right way to think about the answer. Okay, so this is what we did today in terms of little lecture tutorial style of teaching. So hopefully this is interesting to you guys. So let's move on. All right, so let's move on with the discussion. So we'll have a little okay, so just to so Mukul, now you understand what, and everybody else also, you understand how to think about eyeball about intrinsic value. Yes, yeah, the right,
Yes, sir.
right way to think about it conceptually. How much can I make by doing these two transactions? Exercise it and then square it off in the underlying market. If the profit is positive, then I say that's my intrinsic value, $10. If it is negative, I say it's 0. Okay, so the intrinsic value of the put is, if I sell the put in the market, if I exercise the put and sell the underlying asset at 100, and then I immediately buy it back at 110, square my position, then I sell at 100, I buy 110. Actually, it's a loss of $10. That means I write the intrinsic value, I write it as 0. Okay, so that is what, that is, you see the formula definition, that is how it is. That's how you think about it, intrinsic value. Okay, let's move on to the next topic. Okay, so what is so theoretically possible, the impact of one factor can more than offset the impact of the other factor. Yeah, that's why I asked you the question about intrinsic value. So what might happen is, what we are trying to show you is that what is eyeball basically. Let's try to understand once again these eyeball prices that you see, these eyeball prices that you're looking at. Okay, so the 115 call is trading, what happened to the eyeball display? Yeah, 34.872. Eyeball is 34.872. What does this mean? What is this? Let's also understand the meaning of this eyeball. So what is 34.872 when the display here? This is the eyeball display for this 555 okay, price. Now what it means is that if you have, let's say Apple, the underlying price, will put it as 116. Okay, and this is 38 days. We'll just put it as 30 days. Underlying price, will put it as 116. Okay, so we won't have exact. And exercise is 115 call. Is that correct? Yeah, 115 call we are looking at. Okay, so the exercise price is 115, and the price is 555. Okay, 34.99 now is almost 35. Okay, so 555. Let's look at the price. Okay, so if you put days until expiration, let's put it here. What do we have? 38 days. Okay, so we don't know the interest rate that they're using. Okay, but this is too high. I don't think it will be 5. We don't know what the market interest rate the trader is using. Dividend yield also, we don't know what it is for Apple right now. We have to go and see. You have to go to Yahoo Finance and see it, but we'll figure it out. Okay, so let's have rounding of only 2, right? And then the vol is 25. Okay, so what we see is that with the underlying price, we have rounded it off of 116, and maturity of 38 days, exercise price of 115, and interest rates and dividend, we have just given some arbitrary numbers. The I-Vol is 25. At the I-Vol of 25, if we calculate what is the option price, let's look at it. It's 4.3. So what this means is that you see the I-Vol is actually higher, it's 34.99. Okay, now let's put this figure. You see, this is a fair value model. Now here you see when we have the discussion of I-Vol, okay, this whole class is, we are trying to understand I-Vol, and it's a very rich concept, and we can understand in many ways. First is that this is just the index of option prices. So when I want to see which option is cheaper and which is, so I look at the percentage figures here, which is lower. I don't look at the absolute prices. That's one. Okay. Second is, what does it mean? All right, which is the other meaning of I-Vol, okay, which we are coming to also, and this connected to this. But essentially what this means is that, let's understand the meaning of I-Vol. That this vol of 25 is producing a call option price of only 4.3. This is in the OVM, okay, option valuation model. These are the other factors. We are assuming that we are correct about 2 and 1 here. We don't know for sure. Okay, we are assuming. Then the I-Vol is 25. If the I-Vol is 20, if the vol input is 25, it produces a price of 4.3. So the way you understand I-Vol is, this is not good enough for me. I am going to keep on changing this vol input in the OVM until I get a OVM call option output. Okay, this is the output of the model, call option price, output of the model. Until my model throws out an output which is equal to the market price. Now here's the difference between price and value. These are prices. Okay, these prices are being set by the constant interaction of buyers and sellers. Okay, constant interaction of buyers and sellers in the market for Apple options. So you see the price is moving around. First the bid is going 45, then offer is at 50. Sometimes the offer is 555. Okay, so the action is happening, and this is the volume you can see. Okay, option volume. This is open interest actually, and this is the volume. All right, so you can see 5,000 options are trading. All right, so you can see here generally another thing you'll notice that generally at the money will have the highest volume. At the money will have the highest volume. These are things these are the things you learn. That's why I'm giving you this software. Okay, this is what you should look at. And so when you're comparing with other institutions, you should also compare whether they are using this kind of high-tech market trading software or not. Okay, so that's another learning. So there's a lot to learn from the software. You have to explore it yourself. Okay, so the what was I saying here? So this is 5. So this is a difference between price and value. This is the market price. Okay, and this is a difference between market price and fair value. This is the market price coming from interaction of buyers and sellers. And this is not a market price. This is a fair value. This is a fair value, which is an output of a fair value model. Okay, understand that. This option pricing model is actually option valuation model. It's a fair value model, like your NPV, like your IRR. Okay, all those are Gordon growth model for company stocks. All of those are fair value models. Okay, they are saying what the price of the asset should be. And what is this telling you? This is telling you this is what it is. I don't know what it should be, but this is what it is. Okay, so if you go back to your lab, this is positive, and this is a kind of a normative kind of assessment. Okay, that this is what it should be. So how you get to I-Vol, okay, you'll find this discussion in this is another way of understanding I-Vol. Okay, if we go to the this is a second level of understanding of I-Vol, okay, which we are trying to understand, and we'll come back to the first level also to understand this point a little bit better. So the second level is, what am I saying here? These things are very important to understand from the notes and make your own notes, but understand it intuitively first. And this, because this you will not find in the textbooks written, explained like this, okay, in three different levels. So here's what I-Vol is. This, the ball, you can read this. I'm not going to read it. I'm going to give my throat a little because I'm shouting. I have a tendency to shout. So remember, I'm writing this word, theoretical option value. Okay, I can even call it a fair value. That will be even better. Always remember, when you're looking at something, be very clear about whether am I looking at a fair value or am I looking at a market price. Okay, so this is a fair value and there is something which is a market price. Market price does not say anything about whether it is should be or should be that or should be. The market price is telling you what it is. Now you see the prices of calls are going up. It used to be 550, now it is now 560. Okay, so it is the prices are going up. All right, but you see that the I-Vol is actually dropping a little bit, 34.89 now. It used to be 99. So this is how the movement is happening. All right, so you can see here. So what we are saying is, now if you this you can go back and read later on to understand. Okay, just to refer to it. This is so that the reason I write the notes like this is so that people don't have to waste, students don't have to waste their time in the class taking notes. They can focus on understanding what is being taught. Okay, that's why I make the notes like this. So this is what I'm going to explain to you is how do you arrive at the second understanding of I-Vol, which is a mechanical understanding. So always remember that what you're seeing here, these are option prices. You see how sharply the prices are rising. There's a lot of buying and happening in calls. Okay, so prices are obviously being pushed up. So the 115 Apple call is moving up in price. You can see the offers moving up. Okay, and you can see both are moving up actually, bids and offers. Now, this, let me explain what this is with reference to this. So here, to get this, the second understanding of mechanical understanding of I-Vol, what are we doing? I see that the market option price is, I see that the price is 575, okay? Or let's say I take the middle of these two, 570. The price is 570. 115 Apple call for 38 days when the underlying is 116. Okay, underlying is 116. 115 Apple call, 38 days. But my vol input is, we ignore these two, we assume these are correct, okay? If my vol input is 25, the theoretical value, you see this theoretical price, they will always talk about this price when they are using fair value models, okay? So they give you a theoretical price. So the fair value for the call option is 4.3. Now you notice this is much lower than the 580. Here the mid price is 580, 575, 585, 580. So what do I have to do? If anybody remembers, in order to increase my option price from 430 to 580, do I have to raise the, should I increase the volatility or decrease it?
Increase it.
Correct. So let's try it. Let's increase to maybe 35. Let's see what happens to the call option. 5, almost there, almost there. Of course, we don't know. Remember that in real life, we have to be correct about these two also. We don't know because I don't know what the market interest rate is for 38 days. I have to figure it. I have to look at some data to quote price. I have to look at some quotes for interest rates, which I have not done. So I don't know what this is, okay? I'm assuming this is correct. You have to make sure this is correct. I don't know what the dividend yield of Apple is. You have to go to Yahoo Finance and look up the dividend yield of Apple. All right, or go to Finviz and look it up. And so I'm assuming that this is correct. So given those two caveats, so I went to 35, I was almost correct. Now let's try 36. That's too much, right? So 35, around 35 is correct. If you see actually now, this is why they put the I-Vol. You see what is the I-Vol? Now prices are moving up. I-Vol is around 35. You can see that 34.7. Okay, so around 35. So it's basically, that's what we are doing. So this is what I-Vol means. I-Vol means, this is what I said here, as it says here, that if when you are comparing the output of the OVM, okay, which the industry people refer to as option pricing model, but actually it's a valuation model. Pricing, you don't need models for pricing. Pricing is done like this. You can see how in front of your eyes, this price, the mid price has moved from about 550 to about 587, okay, in a few minutes, in less than an hour actually. This is what happens in a market. People are buying or selling, and activity coming, there's activity or buying pressure, selling pressure, and prices keep moving up and down. This has nothing to do with fair value. Fair value is where you put in a bunch of inputs into a model, and you say that if these inputs are correct, the price should be this. Okay, so you can see here the price of 580, now 595. Okay, and let's look at this 34.7 still. So we may be wrong on some of these inputs. Okay, we may have to reduce this, maybe make it 1, and it will have some kind of impact on the price. 571. No, so this is a little bit higher actually they're using. So we'll have to find out basically these inputs. We don't know what these are. Okay, you have to know the right answer for this, but you understand what we are doing. What we are going to do is we are going to keep on changing the vol input in the OVM until we get a output, model output, which is equal to the market price. I see the market price 597. I want to get a model output, fair value model. The fair value model, the fair value output should be exactly equal to the market price of 595. Until I get that, I will keep on changing the vol input. So this is what I-Vol is. Okay, so another way of thinking about I-Vol is what they do. How are they getting this number? Because so that will also help you to understand how they're getting this number, which is so important. I told you that when you're buying and selling options, you don't look at this, oh, this is $6 and this is 2.68. This is much cheaper. That's not what you look at. You look at the I-Vol figures in the brackets. Okay, so the question is, how are they calculating these I-Vol figures in the brackets? So this is what they're doing. They're following these steps. They look at the option prices. Let's take the mid price, or let's just take the offer price to be on the safe side, to make it simpler. Okay, so they look at the offer price. They see the price is $6, and they know everything. They know the tenor is 38 days. They know it's a call. The strike is 115. They know what the underlying price is. The underlying price is now moving towards 117. Okay, they are moving towards 117, the underlying price. Okay, and so here you can see this. Obviously, this inputs are a little bit different. So what they will do is they will put in all these inputs, and the only input they don't know is the vol. So what they'll do is they'll keep changing the vol until they get a model output, which is equal to the option price. Okay, so if you can maybe increase this to 1. Okay, so maybe we can reduce the dividend yield or something, right? And okay, so this is also this. So you play around with these factors, but mainly you play around. You know these actual factors. Okay, you know the actual information for this, but you keep playing around with the vol until you get the option price, which is equal to the market price. Right? So you get the option equal to the market price. That's your I-Vol. So that's what I-Vol means, and this is how they get these numbers. They look at this figure 6. 115 call has a price of 6, and then they enter the other information in the option valuation model, and they keep changing the vol input until they get a model output which is exactly equal to the market price. And that vol input which produces that market price, that's the I-Vol. Okay, the second understanding of I-Vol intuitively. It's a mechanical understanding, which tells you how did they arrive at. Tells you how they arrived at these numbers. 34.70. How did this happen? Okay, therefore this happened because the 605 price comes with 34.70. input of vol. Okay, this is actually 627. So some of these numbers will be different. And the exercise price is 115 and this is 116.64. Maybe we can put this as 116.64 and get more exact numbers. All right, but you get the idea. Okay, so 606. Now you see it's much closer. 605 is the 605 is the mid price. Okay, 605 is the mid price. So that's the price around 606. Okay, so everybody understands the second way of doing the I-Vol calculation. Second way to understand I-Vol, and it also tells you how they arrive at these very important numbers. This 35.06, how did it come about? So if you can understand this, you get a very good understanding of I-Vol. Okay, it's understanding I-Vol at different levels, at different in different ways. I'll just go mute for a while. Okay, so we'll ignore the noise. So now you have understood. So you have understood two different ways of understanding I-Vol, which is very important. Level 1, level 2. All right, and now let's go back to this point, which I'm trying to understand, that this one can offset the other. So what we are saying is this. This is what I mean by the statement. This is also an important thing to understand, because you will notice this is happening to you when you start trading. Okay. By the way, please remember, guys, in this project, you are not allowed. I see lots of people trading in Apple. Of course, this is the practice time. But even in your practice, you should be doing what you can. You should be doing what you're allowed to do in the project, which is buy and sell options. You can't trade in the underlying. You have to right click, go to trading tools, open the option trader, click on it, open the option trader. Then you get this kind of view. Okay. Choose your maturity. If you don't like what I decided to do, looking beyond the election clarity date, if you want to look a little bit shorter, fine, no problem. You want to look at 31 days, you want to go even shorter than that. Okay, maybe that one has expired. Okay, so you go here, all right, and you can do that, but you can choose any expiry, but you should only be trading options. So that means if you want to buy the option, you click here. If you click it here, you'll see that there'll be a pop-up. Okay, there'll be a trading pop-up. Here you see, I just clicked on this 660. So it's ready with the orders. Okay, so if you click on it, then you have to keep this open. And I just clicked on 660. When I clicked on it, it was here actually. So then you'll see that this is ready. So this is just like the way you entered orders for your underlying account. So this is actually this is from my account. Mine is called DI, right? Yeah, mine is DI. So I clicked on it here. Okay. So you can see that this has come. I clicked on the offer price, so that's why it's gone to buy. Okay, it knows automatically that I'm a buyer, and these are the parameters. So I can change these parameters. You can change the. You can see the I-Vol figures. Okay, and you can see the bid and ask. Okay, and you can see all this. Now you can change this. You can give it as a market order. Okay, you can have all these different types of orders. You can learn about all this. Okay, so this is for you to learn, and then you can give your time, whether you want to give GTC or whatever, and then you just hit transmit once you're ready. Okay, you hit transmit. So this is how you buy and sell options. So you should be doing this. You should not be trading in the underlying. So already start practicing what you'll have to do in the project, because in the project I will penalize you if you trade the underlying. If I see any trades in the underlying, I will penalize you. Okay, so you have to do what the project requires you to do, which is only to trade options. Okay, anybody, any clarity, any confusion about this? You understand what has to be done in the project? So already start practicing like that. Start practicing your trading of options only, not You see here, underlying is over here. This is just for reference. This is only for reference. This is not for your trading. You should trade only the options. Okay, you form a view on options. I'll show you how to form a view. I'll give you a framework, and then you have to trade only in the options, not in the underlying. Okay, so that's the main point. So let's understand here what's going on here. Let's understand this statement that the impact of that, what I'm trying to show you here, that you have intrinsic value and time value, and the impact of one on the option price can offset the impact, more than offset the impact of the other. Okay, which is here. Let's look at this. Let's look at this option price. Okay, now you see that's why I started with the question of the intrinsic value. Let's make it simpler. Let's make the underlying price is 120, and the exercise price. So when you buy the option, it's like this. Okay, that the underlying, the exercise price. Let's look at the call option, and the call option has these are the parameters. Okay, and the price is here. We are assuming that this is equal to the price. Okay, the fair value. The price is always trading at fair value. Let's assume, and this is the option price. Okay, so now what's happened is that the intrinsic value in this option obviously is $5 in the call option. Okay, now let's assume the underlying goes up to 130. Okay, now that's too much of a difference. I can't have that won't help me to illustrate this point. Let me just look at 115.5. Okay, let's look at 120. Let's look at 120 first. Let's go back to the original plan. Okay, so it's 815 is the theoretical price at this. I'm just going to round it off a little bit. Let's call it, let's make it like 10. I-Vol, let's make it very small. Okay, and so you have this kind of thing, and let's make it this way. Let's make it even, let's just look at a 115. Let's look at an at the money call first. Let's look at an at the money call, okay, for 38 days. And you see the call option price is 151, okay? And the vol I've entered as 10. Now here the intrinsic value is 0, okay? The intrinsic value is 0 at the money call. Because if you buy this, if you buy the call option exercise, I mean you buy at 115, ignoring commissions, you don't make anything if you sell it off at 115. So the intrinsic value is 0. This is an at the money call. All right. Now, what happens here is an at the money call. Let's see what happens here if this goes up to 116. All right. So 151 is my price right now. If it goes up to 116, so you see this goes to 2.07. Okay. Out of which there's intrinsic value of 1. See, 115 and 116. It is a 115, 116. The IV of the 115 call is $1. The intrinsic value is $1. Okay. Now let's do something. So you went from 151 to 2.07. Okay. Now let me change this I-Vol to let's make it like 1. What happens then? You see what happened? That what I'm trying to show you is that you bought this option initially at 151. Let's call it 150. Okay. When you bought this option, I-Vol was at 10. So when you bought this option, it's a call option. You bought the call option. The price, we are assuming this is equal to the price, or the price is equal to this. The price was 151 when you bought it. Okay, and these were the parameters. And after you bought it, if nothing happens to the vol and the price goes to 116, your price on the call, you're making money on your call option because you bought at 151. Now it's 2.07. So you're jumping up and down and enjoying yourself. But then what happens is this does not change. This does not change, but this I-Vol number, the I-Vol number goes suddenly from 10 to 2, let's say. What happens to the option price? It goes to 109. This is actually lower than the 151. So you see what has happened? You started with 151. Your intrinsic value went up. Can you see? Initially you had an intrinsic value of 0. So then the underlying price went up by $1. So the IV of the 115 call became $1, right? And then you can see here the price, but the price has already fallen. So if the IV of the underlying call has gone up initially, it should have been actually higher in price, which we saw initially for $2. But that time we had not changed the vol to 10. So what we are showing you here is that even though your intrinsic value has actually increased, but because the vol has dropped so sharply from 10 to 2, the time value has decreased dramatically, the time value of this option. So actually the two impacts are working against each other, and the time value in this case, the time value impact is much bigger and much more negative. So therefore it offsets the increase from the 116. As I showed you, if the vol had stayed at 10, then the 115 call has gone up in price to 2.07 when the underlying has moved from 115 to 116. Because you still have the right to buy it at 115 and then you square it off at 116. So you make $1 profit. So that is already in the option price. Now, what is happening? But this is not, life is not so good, okay? You bought it at 151 and now the price is 2.07. You think you've done a great job. But without this moving, the vol suddenly drops to 2. Now what happens to your price? That which used to be 2.07 now is now 1.09, and you bought it at 151. So now you have moved from profit to loss. Okay. So what we are trying to show you here is, because this, remember we already discussed that I-Vol affects the time value. Okay. I-Vol affects the time value of options, and this, the movement of the strike and the exercise price, that affects the intrinsic value of options. Okay. So this is the situation here. So what we are trying to show you now, hopefully you understand. I can explain it better if we have another, if anybody has a question. But the point we are trying to understand here, what we are trying to learn here is that, first of all, recapping that price impact comes from intrinsic value and time value. It's a useful way to think about it. And that's what I've been showing you for some time now, for the last several minutes, is this basically. We're trying to illustrate this. It's theoretically possible that impact of one factor can more than offset the impact of other factor. What am I talking about here? I'm talking about one factor is the IV, the change in the IV, which is positive. Because the spot, the underlying goes from 115 to 116. So the IV goes up by $1 from 0 to 1. Okay. But the vol drops very dramatically from 10 to 2. So what happens is that even though the IV has gone up, okay. So here what has happened, that as the option price consists of IV and TV, okay, the IV has gone up by, this has gone to +1. Okay. So the option price moves from 151 to 207 initially. And that reflects only the IV, because the lower strike calls will have now more value. Okay. As we saw here in the 115 call. Sorry. Yeah. So we are looking at these 115 calls. All right. Here, slightly 170. Our price has already come up here. Okay. So you can see, you can check it out. You can check it out. You can check out the, what's it called? Actually what is happening is I am almost blanking out because for the last 2 days I have not slept because my dad was in hospital. So that's why my brain is blanking out, because I've slept only 3 hours or something in the last 2 days. So just excuse me a little bit here. But anyway, I think you understand what I'm trying to say.
Yes, sir.
That
Yes, sir.
you saw what happened firsthand, right? That your IV went up by $1. Okay, so your price would have gone up from 151 to 207, but that didn't happen because the vol dropped from 10 to 2. So the IV impact is positive on the option price, because if you change this vol back to 10, okay, if you change the vol back to 10, the price goes to 2.7. But it's not so easy because the vol has dropped to 2. Okay. So therefore, even though the IV impact is still positive, it goes from 0 to 1. But the time value impact is so negative, because if the I vol drops, then the option price will drop. Okay, and here we are assuming always that we are setting the market price equal to the fair value. We are assuming that the market price will be equal to the fair value. Under that assumption, we are making this calculation. So what is happening here? That this drops from 151 to 109. So this is what I'm trying to show you here. This is the point, that impact of one factor can more than offset the impact of the other factor. In the example I just showed you, the impact of the time value is so negative that it more than offsets the increase in the intrinsic value, the positive impact of the intrinsic value change. So intrinsic value goes up by $1, but still the drop in the volatility drags the price all the way down from 207 to 109. So this again shows you that the I vol affects the time value of the option. Okay, so this is a useful framework to keep in your mind, that the option price is always equal to IV plus TV. So that means when you look at this option price, you should also practice in your mind, as we saw today. I'll just close this trading thing. Okay, you can see in your, here, you can always practice in your mind that when you see this, this is 31 days. Let's look at a slightly longer option chain, 44 days. And the price is now already, you see in this one session, the price has moved from 115 to 117. And you can see, let's say if you look at a slightly deeper strike call, like if you take an example like here, 114 call, okay? 114 call has a price of say 715 or something like that, okay? Mid price, 720. 720 is the price of the 114 call. Straight away, you should calculate what is do this practice for yourself to get clear about the theory. The intrinsic value of the 114 call will be, if I buy the underlying asset at 114 and I sell it off at 117.21 in the market, then I'm making $3.2. Okay, $3.2. So that out of this 7.25, the 3.2 is the intrinsic value, and therefore the balance must be time value. Okay, so because the option price is equal to intrinsic value plus time value, so the balance must be time value, and that's how you should think about the option price. And the time value, this you see the I vol is 34.54. If you keep everything else constant and you increase, if you reduce that I vol from 34 to 24, then this price will all drop. The prices will all drop, even though the IV is not changing. This is not moving anywhere. This is not dropping. So if this is not dropping and the strike is fixed, then the IV is not going to change. But the price of the option can still change because the I vols may drop. The I vols may drop. The I vols, remember, a index of option prices. So if there is less demand for options in general, then the IV will start to drop. That is what you're seeing here. This is how you try to make sense of all this. If you go back to these charts, okay, if you see we are looking at Apple, okay, let's look at Oracle, doesn't matter, it can be anything. You see the IV index mean, Okay, you can also launch the other charts that I've given you here. This is actually, there is a better chart ticker that's on top of this actually here. I think that's here. No, not here. It's over here. Okay, I-Vol charts 2 here. This one. This gives you better charts, longer term charts. But I'll just introduce the concept. I'll discuss the concept. What is happening here? The yellow line, the I-Vol index is going up and going down. This means that option prices were generally increasing. This I've discussed before. Option prices were generally increasing by between Jan and March, and now option prices generally falling. Okay, so they're generally falling, and then during this period, May to June, November, there is not much movement. Actually, it is ranging between 20% and 40%. What are these percentages? These are these numbers. See the numbers we are using here. Okay, that is for Oracle, but these are the numbers. This 20% and 40% you see on the chart. This 20 to 40% range. These are for these numbers. When you mouse over that 33.89, that's the percentage that they're talking about. So you can plot this. You plot it over time. You take an average of these IVs, okay, and you talk about this. This is the IV here. So they've given you the average IV for this maturity is 33.3. And if you plot this, and this is today's information only, and this is not even today, this is only for current moment, okay? Suddenly if there's a dramatic movement, then this IV will change today itself. But if you take daily data and you plot it like this over time, you get this chart. So this means as this goes up, means options are generally expensive. This is going down, that means options are generally cheaper. So that's how you understand it, okay? So this is the second part of it, which is this here. Oh, actually we went back up to load this here. You see how this has got this has got much bigger data set here. Okay, it's a much bigger data set. If we take what are we looking at? Apple. If you take Apple, you can just experiment with this. You will get a lot more data. You can actually see how it has moved. You can drag this back out. I think you get about 3 years of data. You see a real good, this they have not adjusted the price. There was a stock split in Apple. So this data set is actually not correct, but the IV information is correct, okay? The IV information is correct. The chart, the stock price is not properly plotted because they have not adjusted for the stock split. So for the chart, you can use this, okay? This is adjusted. But for the IV, long-term trend of IV, you can get better here because it has more data, all right? So that's basically what we mean here in this particular point. And this is also an important thing to understand. You will see this happening to you as you trade options. It can happen to you. It can very well happen to you. It has happened to some of your seniors, okay, that this point, which is very important to understand, that one can offset the impact of more than offset the impact of the other factor. That's what we're trying to show you here. So we have understood this first part, and then the second part mainly also a little bit today. The second part we have understood, okay, and so now we can go on to so here this in the second part. Another thing theoretically you should understand is this. See, this part you have already understood. We have discussed this. You have already understood the second part. That what is I-Vol is I take the market price, I keep it in mind, and I keep changing the vol input in the OVM until I get a OVM output which is exactly equal to the market price, and then I say that vol input is my I-Vol. That's what I-Vol is. Okay. So sorry, I've got this continuous movement there. Okay, so that's what I say the I-Vol is. That it's the input which I get, which will create a model output exactly equal to the market price. Okay. Now, what am I saying here? I got distracted actually. Okay, this is the statement I want you to understand. That I-Vol, it'll cement your understanding of I-Vol. I-Vol is a species of vol input in an OVM. I've given you a throwback to your contracts class. Contract is a species of agreement. Okay. BCA student is a species of student. LLB student is a species of student. There are other types of students. I-Vol is a species of vol input in an OVM. Why? Because you can have all kinds of vol input in the OVM, but they may not necessarily result in a output. Every vol input that you put in will create an output. Now I can put in 10. Okay. This will create one output of 2.07. But suppose the market price is not 2.07, it's something else. Okay. Suppose let's say 5. Then this vol input in the OVM is still a vol input, but it is one of many vol inputs. And one of these vol inputs will end up being the I-Vol. Suppose I said the price is 5. So let's make it like 30 and see what happens. See, great. That is just a lucky hit. So you see, these are all inputs. Now I went from what was it, 10 to 30. Okay. So I don't have to go from 10 to 30. I can go from 10 to 11, 11, 12, 12, 13, 13, 14, 15, then 16, 17, 18, 19, 20, 21, 31, 27, 26, 20, 26, 27, 28. Then I come to 30. So I have all these inputs, 10, 11, 12, 13. These are all inputs. And the 30 is also an input. Okay. So this is why I say, but this 30 is a peculiar kind of vol input because it is the only input which will be called the I-Vol. Okay. Which will be the I-Vol. Okay. For this option with these parameters, because it is that particular unique value of the input which is creating a model output exactly equal to the market price. So that's why I-Vol, if you, the sentence is complicated, but it is required for you to understand it because it will cement your understanding of I-Vol as given in the second definition, mechanical answer of I-Vol. Okay. So you, and this is also connecting to your language, use of the language, and connecting back to your contracts class and understanding sets and subsets. Okay. This is a subset. This is a set. Okay. So this subset is a part of this larger set. All students, LLB students. Okay. So all the vol inputs in an OVM. We'll stop it just now. Finish it off once. All right. Okay, we are done. All right. Okay. So I'll just finish it off once very quickly. Okay. So what we are saying is that this, make sure you go back and understand the why do I have a message from my Zoom fellow? Okay. Zoom is giving some kind of message. Okay, never mind. I'll just finish it off here. So try to understand the statement also. It will cement your understanding of subsets and subsets, species and genus, okay, and larger groups and smaller groups, and connecting it to the idea of I-Vol. I-Vol is a species of vol input in an OVM. Okay, it is also a vol input, but it is a unique kind of vol input which produces a option model price, OVM price equal to the market price. Okay, so that's the end of the class today. So everybody else can go, and Mitali and Shaurya should stay back, and anybody else who has a question can stay back. Okay, so I'll see you guys tomorrow 11:15. I'll send out the invite a little later. Okay, all right. Okay, good night, guys, folks, guys and girls.
Thank you, sir.
Thank you, sir.
Good night, sir.
Good night.
Thank you, sir.
Shaurya and Mitali and anybody else with a question. So we'll start with anybody has a technical question. I'll stop the video recording.
Yes, sir. About the other values, how do we get it for this, like interest rates, dividend yield, rounding, and graph increment?
Dividend, interest rate and dividend yield.
Yes, sir.
Interest rate you have to find out from, these are a little difficult to find out. You have to find out from some website which has interest rates, okay? Like the Federal Reserve, the US Treasury websites, okay? You can look at the Treasury bill curve, okay? You can look at the T-bill rates. So essentially go and find US Treasury bill rates. I'll give you some websites later on. Okay. You can find the US, but I'm just telling you the logic. You go to find, here you find, try to use the US Treasury rates. Okay. And you can find some data publicly on US Treasury interest rates. Okay, so that's the first answer to your first question. How do you find it? We are not going to do it right now, but I'm telling you how to do it. Look for US Treasury yield data and enter that here and find your tenor and then enter that. Okay, that's one. Second is, so answer for the first part. Are you satisfied, Siddharth? Hello, the question was from Siddharth, right? What happened?
Yes, sir, it was from Siddharth.
Yes, sir, it was from Siddharth.
So he has gone quiet. Okay. So I'm trying to find the chart link actually. I'm just trying to find the chart link. Let me just find US Treasury. One sec. US Treasury curve. Yeah, let's just find the chart. Yeah, so here you can find, I'll just get it here. One second. I hope the chart loads because sometimes, you know,
I'm sorry, sir, my net actually went off. I'm really sorry, sir, my net went off.
Yeah, okay, no problem. See, here you can find it actually. I'm not sure if the, so this is what you find. This is the US Treasury website. Okay, so the basic logic is that you have to find the US Treasury interest rates for the particular tenor. Okay, so in this case, you go to the US Treasury website, you see the tenors. Today is 11, closest to 11.9. Okay, so you see these are the interest rates. Now you want 38 days, so you have to do some, you can do simple straight line. There are many ways to do interpolation. You can do cubic spline interpolation. You can learn that maybe in some of your quantitative classes. But you can also do simple straight line interpolation. So you take the, if you want 38 days, you take a 1 month and 2 month in between, both are the same anyway. So that is then same as 10.1. So then this will become 0.1, okay? The treasury interest rates. Okay, you will have to enter 0.1 over here. Here.
Okay.
So not 1%, so it's actually 1%. So it is actually, if it is 0.1, you have to enter 0.1 actually. Okay, so because you can see here, this is 0.1, so you have to enter 0.1 here. Okay, dividend.
Sir, off the topic question, sir, why have the interest rates been decreasing from greater percentage to now it's about 1%, sir? Why is it so? Over the years, like it was earlier, it was 4-5%, and then it has decreased to 1% now.
That is a very long, that's a very long discussion actually. We'll do that some other time. If you just remember to, but it's a very long discussion, but we can do it some other time. Let's do it because it's a very, very long discussion. It's almost several, it's almost like a course. So what you're asking is a course, but I'll give you some broad idea, but at least, but still it's a very long discussion. Okay. We will not be able to do justice to it right now. So you remember it and then you try to do it. Because today I'm just tapped out actually. My brain is blanking out. Okay.
Excuse me, sir.
Yes, I'm sorry to hear that, sir, and actually I wouldn't know.
No problem. I just, it's also that answer is very long. Okay. So what Siddharth is asking is why is this, if we take this actually TNX is because I also have a tendency to talk too loudly. You know, this is what it is. No, this is actually your US Treasury 10-year interest rate. So this stuff that you see 10-year US Treasury website, 10-year. Okay, I don't know if the figures are big enough for you to read here. Okay, 10-year, you can see 0.96. If you look at the chart, it will be the same. Okay, 0.96, it should be 0.96 here. If there is some movement here, okay, yeah, 0.96 actually. This 13.4 is different actually. There's a mistake there. So this is 0.96, around 0.96. So this is the rate. What Siddharth is asking is, why is it declining like this? Now that answer is a very long discussion. To do justice to that answer is a very long discussion. Essentially what it means, at least you can understand this in mechanical terms, it means that in say October of 2018, the US Treasury had to pay 3.2% to borrow money for 10 years from international investors. But today, the US Treasury is paying something at 0.96. Okay, so that's what Siddharth is asking. What caused this massive drop in interest rates? Now, the answer to that is not very simple. It's a very long answer. So we'll do it some other, I'll try to give you some structure around it. As to when we have discussions in the next course, we will actually have discussions on interest rates and how they are, how they are constituted. This rate of 3.5 or whatever, 3.2. This also has components, just like an option price has components, fair value, intrinsic value, and time value. This also has components. Okay. There are two components for this one, and for corporate bond deals there are three components. So we'll do all that as a discussion, and it will happen in the next course also. But broadly, I can say you can think of two things. That one is that there is a less fear of. I'll just give you a short answer. There's less fear of inflation, and investors are also requiring less of a real return. Okay, these are the two ways to think about it. That investor sentiment has changed, and they are now happy with lower returns. That is why the way we think about it. That's another way of thinking about it. Another way is that there is a tremendous amount of demand. Remember, we have not covered this with you guys, but you might have covered it in your FM1, FM2, that interest rates are inversely related to bond prices. So if interest rates are falling, that means bond prices are rising. Okay. So there is another way to understand it is that there is tremendous demand for bonds, US Treasury bonds. Prices of US Treasury bonds are rising dramatically. So the interest rates on those bonds, the yield, the YTM, this is the YTM, that is dropping dramatically. Got it? So that.
Yes, sir. Yes, sir.
But as I said, whatever I told you is true, but this is not the end of the discussion. There's much more to it. So it's a very, very long discussion, and partly you will get some answers in the next course in IFM when we discuss the components. So it's a very, very long answer actually. But whatever I told you now is also true, that mainly you can think of it in simple ways. Bond prices are going up. Interest rates are falling, means bond prices are going up. Why are bond prices going up? Because there is excess demand in the bond market. It's a kind of a stupid answer because it's mechanical. Why are onion prices going up? Because there is excess demand in the onion market. Actually, what your question is, why is there excess demand in the onion market? And actually, the answer to that is you will never know. Nobody knows why. Okay, investor sentiment can't be figured out. So that's the broad answer to your question. But it is a very long discussion. We can have that discussion another time, and maybe we'll have it over several sessions. You'll get some of your answers. Is that okay, Siddharth?
Yes, sir. Yes, sir.
Excuse me,
I'll
sir.
I'll ask you another time.
Excuse me, sir.
Yeah.
So where we can get our previous classes recordings?
Recordings will be on the YouTube channel.
Sir, actually it's not showing on there.
No, because you are using my earlier channel. Because remember, DG sir had stopped the recording, so I started uploading to another channel. So you have to see. You have to show you one second. Good question, actually.
Okay, sir.
One short answer to your question is here. I have made sure that you guys have access to it.
Okay, sir.
Go and click this. Because DG stopped the recording for some time, no?
Yes, sir. Yes, sir.
I couldn't stop the recording. I made sure that I uploaded, but I didn't share with you guys until you allowed it.
Okay, sir.
What I'm doing here is instead of putting the individual videos, I am linking to the playlist. Okay. So
Okay, sir.
the playlist and bookmark the playlist.
Okay, sir. Thank you, sir.
Why it's only 8 over here? Actually, couldn't there be I don't know why this is. No, yeah, this is the right link, but I have not uploaded the other two. Why is this? Maybe it's not gone on to the. I'll check it. Today's session, what, 9? Today's session, I'll just check 1 minute.
It's 10th, I guess, sir.
10th session. That means I have 9th, I've uploaded it, but I didn't put it in the playlist. But I'll make sure that it is correct. But you click on this and you'll find it. Okay.
Okay, sir. Thank you, sir.
So I'll come back to Siddharth's question. So for a short question for finding where to find the input here, answer to that, you go to the US Treasury website, find the maturity and enter the value. Okay, that's one. Number two, dividend yield. I'll just find out, I'll just tell you this. You go to Yahoo Finance or any other place. Okay, let's say we go here. Let's go to Yahoo Finance. Go to your master list. Okay, Yahoo Finance. This is a chart actually. What we need is actually the tickers. Yahoo Finance, maybe the option tickers. Maybe, I don't know. This is just the analysis. We'll find it in the summary page. What chart are we looking at? Apple we were looking at, right? We were looking at Apple option prices. So let me just enter Apple. And so, no, this has gone to Alcoa actually. Because Alcoa is AA. Okay, let me click on Apple. All right, so 117.36. Now here you see in the summary, this is one way to find it. You can find dividend yield in a lot of other places. I'm sure FinViz will also have it, but let me show you how to get this summary. I think this maybe Zoom is too much. Okay, where are this summary? Why are they giving the summary like this? Okay, here, dividend yield here. You see, forward dividend. So the forward dividend yield, you can use that. So this is where you find this. The answer to that second question is Apple dividend yield is 0.82. No, 0.82 is the dividend and this is the yield, 0.7. Okay, so here you will enter 0.7. So dividend yield you will enter 0.7. Okay, interest rates you will enter 0.1. And then you can see the price of the option. Okay, so this is how it is. So Siddharth, this is your second question. Where to find it? Is this clear, Siddharth?
Yes, sir. Yes, sir.
How you find it? Okay. Yeah, so this is as far as Siddharth's question is concerned. Now, any other technical questions? Then I will go to Mitali and Shaurya and ask about their. I'll stop the recording and then I'll go and talk to them about their administrative question about account setting up and all that. Any other technical question, conceptual question?
No, sir.
Okay, all right. So we'll come to Mitali and Shaurya. I'll just stop this right now. Maybe I'll just stop the recording. Okay, 1 minute.